Hi, everybody. Welcome to episode 102 of Martinis with Scott. Wait a minute, Scott, you said 102? What happened to 100? How did the number count get so high? I started doing some daily shows this week, just 15 minutes live streaming, just to see how it goes, to see if people like it, if they would like to engage in a dialogue, ask some questions. And so the show count number is going up quickly. We missed our 100. I had planned an invite to some of the original cast members, so to speak, like Olga and David and Ashley and some others, but that didn't happen. I think in the next couple of weeks we'll set up a Zoom show with that cast of characters and have a couple of drinks to celebrate that Martinis with Scott has survived this long. Let's have our drink. It's good to see you on a Thursday afternoon. Cheers. Oh, that's a good, well-needed martini. Now, a couple of things. First of all, Susanna, thank you for watching and commenting. I have not yet bought coasters for this new home office podcast studio setup of mine. I know the perfect coasters for it. They're on the other coast, but when COVID is over, I'm going to go grab them. In the meantime, I'm using my Wolf of Wall Street book as a coaster to try and limit the noise for you. Sorry about that, Jordan. For having a martini on your face. And on the podcast, I was holding up Jordan Belfort's The Way of the Wolf Straight Line Selling, which is a terrific selling process book. And also, Susanna, I wanted to thank you for the book reference, Getting More by Stuart Diamond. I've downloaded the audiobook, but haven't had a chance to open it up yet. So, like I said, doing daily shows now. Give me some feedback, please. Do you like the idea? Is it a waste for you? I mean, at a minimum, I think I'm gonna hopefully hack the YouTube algorithm a little bit, so maybe that will help. We'll see. I also joined the app Clubhouse this week, and my God, do I love that app! I can't stop listening to it. I'm actually going to host a show. I think it's scheduled for Monday at 6 p.m. on Eastern. So if you're on Clubhouse, connect with me there, please, and it'll be an audio show. I think David Cohen, a national partner at Gowling. WLG, an international law firm. He and I are going to sit there and rap about business stuff, corporate finance, financings, restructurings, turnarounds, starting businesses, and we'll see if anybody shows up to have a conversation with us. I'm excited, and that should be Monday, 6 p.m. Eastern. Okay, what are we talking about this week? I want to talk about partnerships. We'll see how we do for time, but partnerships, shareholders agreements, and what started that, I'm really enjoying this martini. What started that was on LinkedIn this week, Rob Fraser, who is the founder and CEO of Endur Apparel. I'm going to say appraisals. Dealing with too many appraisers these days for asset-based loans. Endur, spelled E-N-D. We did a show with him on Martinis with Scott channel. You can look back to that where we did an interview style type show about the trials and tribulations of being an entrepreneur. And then check out Endur Apparel on the internet. We'll get a link in. Ashley, let's get a link in for Rob into the notes to the show, please. So they have a pretty cool sock company, and maybe there's more apparel coming out because I saw an Instagram post of a good-looking T-shirt that Rob ought to be sending me a box of because I need them. All right, large, Rob, maybe even a tad larger than large. His LinkedIn post: 2 years into building. I'm sorry, I'm reading to you, but I try not to do that. But I need to set the stage for what we're going to talk about today. 2 years into building Endur, I found myself with an absent co-founder and investor. We had just crossed 1 million in sales, and I quickly realized that what got us there wasn't going to get us to where we needed to go. Without a shareholder agreement, red flag, red flag, red flag. Excuse me, choking on my martini. Without a shareholder agreement, I found myself between a rock and a hard place. My only card to play was offering to buy them out or walk away. I simply could not continue to do all the work with no help and only 36% ownership. I'm going to talk about shareholders agreement and 36% ownership when I'm done reading this to you. When proposing we meet to resolve the issues, I met with severe belittlement. Below is just one of many comments from the investor. Quote, your lack of understanding of having a partner and what it takes to build a business or how much effort it takes surprises me. If you feel this is too much for you, then I will find somebody that can come in and run the company. End quote. First of all, I'm not done reading this, but if I may interrupt, for long-time listeners, you know, we did a series about a real person with a hypothetical name, Mary, and the problems that she had with her partner in launching a business. It sounds like no shareholders agreement. It sounded precisely like this issue, and it devolved immediately into belittlement and personal attacks, just as Rob experienced. I've seen this 1,000 times in my career. I've seen this between partners and startup companies. Take heed to what Rob is writing, please. Did I make mistakes in the first 2 years? Of course. But I was learning, and this individual was supposed to guide me. 99% of what was promised was not delivered. After 24 months of trusting, they made good on their word. Through sheer will, I persevered and acquired control of the company and have since 5 times the annual sales. Moral of the story, know your worth and never compromise when others don't hold up their end of the deal. I always bet on myself. Nope, that's not what it says. It says always bet on yourself. All right. First of all, Rob, thank you very much for posting that on your LinkedIn. That's a authentic, heartfelt, but I think it's just such an incredible lesson for entrepreneurs. As I said, you just see this over and over and over. But I think there's other morals between always bet on yourself. And I think the other morals are, for example, why do you have a partner? You better think twice about that. Don't give away your company. Why are you at 36% and you're at $1 million of revenue? Why don't you have a shareholders agreement? Those would be some examples that we ought to talk about from that post. So I did a quick shot on martinis with Scott, I don't know, last year sometime, probably a year ago now. Maybe 6 months ago. I think it was entitled Don't Give Up Your $1 Billion Dream. Before I'd even had a conversation with Rob, just to give you an idea of how repetitive these types of stories are. And I'm going to sort of work off the same script right now because I think it's a direct hit. So let's go on a hypothetical journey. You're young, or even if you're not a young, by the way, when I did this Don't Give Away Your $1 Billion Dream episode, I had multiple high-profile serial entrepreneurs who have been ultra successful in life who said to me, you know what? I've done exactly that multiple times in my career. I wish I never had done that, and I wish I had this advice, back when I was younger. All right, so you're a what does my iPad said? Software will be auto-installed. I hope it doesn't do that during the show. You come up with a business idea. You're a wannabe entrepreneur. You're convinced you've got the next big thing, and it's going to be worth someday $1 billion. Okay. In Rob's case, he's building a sock company, and it's going to be a huge success. He's going to be an entrepreneur, and it's going to create his wealth. And God bless him for succeeding to date. So what do? What do most people do when they're doing this? Well, they've got this idea. They want to become an entrepreneur. They go out, start talking to their friend about it. Hey, I got an idea. What if we build these widgets that are new and improved, and we have a direct-to-consumer model supported by tons of content to create the brand, and we make them a little flashy with a bunch of colors. It's a better mousetrap, and we can dominate the market, and it's a hot, trendy item. What do you think? And your friend says, yeah, that could be a good idea. What about this? What about that? How are we going to capitalize it? How is this going to work? All of a sudden, your friends start to say we in this conversation. Before you know it, you've had a couple of meetings, you've had a couple of drinks, you've gone out for a nice steak dinner, and all of a sudden you have a 50% partner. Let's do this. We are so excited to do this together and to go down this adventure, and 50-50. There you are. You've started a company. You're an entrepreneur. Congratulations. At time zero, zero revenue. It's not just pre-revenue, time zero. You haven't even got the incorporation yet, and you already have diluted yourself by 50%. In your business, you own 50%, not 100. By the way, I want you to keep in mind during this story that when you're talking percentages, there's only 100 of them. You never get more, notwithstanding the Bugsy Malone story where he seemed to come up with more than 100%. In that casino movie, I think it was Casino, in reality, in real life, there's 100%, and you just gave away half of those, and you haven't even started yet. So it takes a couple of months. You get sort of on your feet. You have your plan. Now you need a product designer or a technologist to get on your platform, to get the e-commerce side going, because that's part of your strategy. Remember, this is a hypothetical business, so whatever. You need a guru to do the nuts and bolts of what you're actually doing okay, but you're doing it 80% okay, and there's people that are better. You need a guru, and you need to focus on other stuff. You need to focus on sales or marketing or something else that's more in your wheelhouse as a CEO, entrepreneur. And so you're competent, but you need a guru on your team. And by the way, it's that guru that's going to help you get the cash, right? The big bucks is that guru that you can go to the VCs or the angel investors and say, hey, look at the guru I have. That brings value to my company, and you should write us a check. Now, you need to motivate that guru. You don't have much money or any money, right? So you can't pay this guru several $100,000 in an annual salary. You can't pay him a bunch of bonuses. You have to give him stock, right? There's some sort of base salary, so the person can pay their rent and eat, but then there's upside. So how do you motivate and entice this non-founder but key employee? So far we got 2 founders, 50% each. Now you got a new key employee you want to bring in. How much of the company should they own? How do you decide that? How does that work? What is the stake? Well, look at it, it's less than 50% because that's what you own. In fact, it's less than 33% because now if there's 3 of you and you were all equal, the maximum you could be is 33% each one, 33 and 1/3, right? So, but this guru is not a founder, so it needs to be less than 33. So there's your high end. It's the ceiling is, somewhere below 33%. Well, what's the floor? Can't be less than 10%, right? Because that would just be insulting. Here, you're a guru and you're instrumental to me creating value for my company. Here's 5% of the business. That's not going to work, right? So you have a floor of, say, 10%. You've got a ceiling of 30, 33%, somewhere in that range. Where do you end up? You end up at 20 to 25%. That's where you end up. I've seen this lots of times, as I've said. The next guy in the door that's a key employee beyond the founders ends up with 20%, sometimes 25% of the company. You give that person 20%, that's 10% out of each founding partner. You've gone now from 100% to 50% to 40%, okay? Now you own 40% of your company. 3 of you are working day and night, start to make some progress. Now you need to hire your next person. And let's say this is in marketing and sales because you look pretty good. You got the platform, the technology built, you got the product. You need to start pounding this thing out. And so you need to hire somebody. Again, you're doing an okay job, but it's time to move to the next level. A 3-person company is not a $1 billion company. You need more talent, so you bring in the 4th person, but you're still pre-revenue. You can't pay them a bunch of money. Same story as the last person you brought in. So you need to give them a stake. Well, what's the stake? It's less than what you have, which is 40%. It's less than the 20% that the last person got, because this person's coming into a less risky and therefore more valuable situation, right? So if the last person got 20, what do you give this one? Let's say in the range of 10 to 15%. You still got that 10% floor issue. You can't convince somebody they're a, employee number 4 of this company and they're going to make a ton of money and then give them nothing, like very little stock. So let's say 10%. It usually ends up in the 10 to 15% range. So now you've gone from 40 down to 35%, right? 10% from everybody, and it's not quite 35% because there's dilution for everybody, but close enough. You get down to about 35% of your company. Hey, do you remember Rob's story where he said, I simply could not continue to do all the work with no help and only 36% ownership? Bet you it was a different path, because he brought in some angel money, it sounds like, to do that. But look at that. In my hypothetical example, which was 6 months ago, I said, now you're down to 35%, and he and his story was down to 36%. All right, what's next? Now you need to start paying people. You got 4 people in the company, you're pre-revenue, and you need some cash. You need to start buying some raw materials, start producing your widgets or whatever you're doing. You got distribution costs. You need to bring in a little money. How much is the angel investor? You're not ready to go to a VC or a strategic, so you're going to go locally. You're going to get the angel, which is money, which is part of Rob's story that they were supposed to put in. Did he give a number? I think it was $100,000. He did not give a number. They were supposed to put in some money. He had problems with that. I'm taking it from his story. But in our example, your pre-revenue, you need to bring in some angel money. The angel's going to take, let's say, 30%. Now you're down to 24.5%. You got a few $100,000 in the door. You got 4 good people. You're really ready to head into a revenue model. You're moving from pre-revenue to producing product, getting out the door. You got a little bit of cash, not very much, and you've got 4 people, and you own 24.5% of your business pre-revenue, down from 100 to 24.5. Now, if your next deal, you knock it out of the park, you make a bunch of money, you create a significant valuation, whether that be my fund to talk about, $1 billion or 100 million or 10 million, whatever. You create value, and your next deal is a big check. That's not crazy dilutive, right? You sell to you sell to a strategic purchaser, you bring in a good big check, you bring in a VC for a big check, and you've created so much value, it's not crazy dilutive. Congratulations. The 24.5% was worth significant money, and that was a great entrepreneurial venture for you. But what are the odds? What are the odds of that happening first time? You got 4 people, you're pre-revenue, you brought in some angel money. What are the odds that you're going from there to economic success, to financial success, to valuation success? Well, we can actually answer that question. It's not just rhetorical. We can look at the venture capital model. Venture capitals invest money into early stage companies that are higher risk. They're super sophisticated people, these venture capitalists. They're very smart. They do a lot of math and a lot of models, and they come up with their valuations. And what's their success? Well, their success is no more than 20% of their portfolio. 2 of the companies, if they invest in 10 companies, 2 of them are going to outright fail. 6 of them are going to bump along and never return any funds. So they don't die, but they don't succeed. And 2 of them succeed, and they generate all the returns. So there's a 20% success rate right there. When I ask you, what are the odds you're going to be successful? Well, that's a 20% success rate, and 80% of them don't succeed. Except guess what? That's 20% success rate on the ones that the VC accepted to invest in. It's the companies in their portfolio. All these smart people, girls and guys, sit around. They look at thousands of business plan, and they reject all the thousands except for 10, and they invest in those 10, and then only 2 of them succeed. Okay? The chances of you being successful pre-revenue with 4 people, a little bit of money, and when I say being successful, I mean being immediately successful without a dilutive event. Okay, you can be successful because you worked your ass off, you persevered, and 5 years from now, you pulled it off. Awesome. But what were the dilutive events between now and 5 years from now? And by a dilutive event, I mean something that cost you more of your stock. Remember, you were at 24.5%? What happens, for example, if it turns out your friend, your partner, isn't doing what you thought they should be doing? That turns into resentment and the need to find someone else to fill the hole. Not the hole that they were doing, but the hole that you thought that they should be doing. You brought them in for a reason, I hope. And what should they be doing? Well, you need to replace that, right? Or you need to work 20 hours a day instead of 10 hours a day, or 24 hours a day instead of 20 hours a day. Remember, I told you this 6 months ago before Rob's email or his LinkedIn post, Was he not talking about a partner slash investor who wasn't doing what they were supposed to be doing, and it turns into resentment? This is exactly what happens. That's why I love this post from Rob, and I thank him very much, because it just helps me hammer home just huge mistakes, key mistakes that you see over and over from entrepreneurs. What happens when your project needs more money, more than you planned, and you need more dilution, and you're only starting at 24.5%, or restarting at 24.5% at this point, and you need to get more from the angel investor or new angel investors or some other method to get some capital in, just to punt the ball down the road, so to speak, so that you can kick the ball down the road, so that you can persevere and make a success out of this. What happens? Even if you're successful, you're down to 10% of your business, 20% on the upside of your business, just because of that whole process. And the important part is it wasn't all necessary. You could avoid some of this. How would you do that? Let's talk about partnership first. And I know that I did this show with Rob, and we talked about partnership. And I've had many friends that I've talked to this about. I've seen it in clients many times. I've not experienced it myself because I've always had this anti-partner view. I think if we could get true answers, an honest answer, an authentic answer from entrepreneurs that have had partnership problems, and go back to the Mary shows. This is another perfect example. I bet you a huge percentage, and if I were to put a number on it, I would say 90%, like it's a huge number. 90% of partners that form a partnership to start a new venture, an entrepreneurship, they do so because of fear. They don't want to do it themselves. They're too fearful. They're not believing in themselves. They're insecure. They don't believe in themselves. They're lonely. They're fearful of sitting by themselves at home or in an office environment or whatever environment they have, starting their own business and being the only person with no one to talk to. They're terrified of that. I was listening to a Clubhouse chat about that just or maybe just last night, and an entrepreneur was saying that's exactly why he took on a partner. He just found it lonely and wanted to bring somebody in that he could talk to. So fear, insecurity, loneliness, or a sense of adventure, right? A sense of, we're going to go down this path. We're going to take a risk. Rah, rah, rah. We had a few drinks. Let's do this together. Comrade kind of spirit. That partnership is not going to last, right? If you can't, here's how you know, okay, you need to start by thinking, I don't need a partner, period. Right? And then you need to say to yourself, are there some serious skill sets that I lack? Like, let's say I'm a great front man, CEO. I know the financial side. I can do the sales and marketing. I can do the branding. Let's talk about me, Scott. But I know nothing about technology, like nothing. If it's not an Apple platform, I don't even know how to use it, right? So if I'm starting a tech company, maybe it's a good idea for me to have a founding partner that fills in that broad skill set, and that's their responsibility. I can't go hire somebody. I have no money in this startup, and it is so fundamental to the core and the strategy of the business that you want that person to be a significant shareholder anyways, right? I'm not basing my partnership on friendship. I'm not basing it on fear. I'm basing it on, I have a need. I have a need for a partner. It makes sense to have a partner. And so I'm going to go down that route. Now, does that partnership need to be 50-50 if it's no longer based on friendship? Of course not. You could try to value that role and come up with a different number. But I'm telling you, if you are bringing in a partnership based on insecurity, fear, I don't know what I'm doing, this person knows what they're doing. That's exactly what the Mary thing was. She wasn't confident of her understanding of the industry, and she thought her partner would be older and wiser and had experience in the industry. I don't recall the conversation with Rob. I'm willing to bet he was coming out of school, and it was sort of the same thing. He found an angel entrepreneur who was supposed to mentor him, supposed to help him, and then he just felt left alone. I'm willing to bet that's what happened. I don't know that for a fact. What does it turn into? What does it turn into when your mentor lets the mentee down and they're 50-50 partners, and the mentee has the fortitude to stand up and say, hey, mentor, not only do I not think you're doing your part and your advice is no good, but you're screwing up. You're hurting the company. Do you think mentors like to hear that, or do you think that turns into resentment? That's what happens. That's what happens. Now, if you do have a partner, and you give them a bunch of shares, 50-50 or otherwise, this isn't optional. You need a way to get those shares back. That has to be part of the deal. What if you give away half this company, you get a patent, you've created real value, but there's a lot more to go, and your partner gets hit by a bus, and he has no heirs? I mean, you can't get your 50% of the company back. You don't have a shareholders agreement. What happens if they just leave off? They find a bigger gig, a better gig, they get a bunch more money, and they just leave you. What happens if they're not helping you at all? Like in Rob's situation, there has to be a way to get those shares back. One way to do that, and if it's shares, probably the only way to do that, is a shareholder agreement. And Rob said he learned he doesn't have a shareholders agreement, and the importance of one. So what does a shareholders agreement do? It is a contract, a private contract between parties being shareholders. And it basically says, we the shareholders, this is how we agree this company is going to operate. This will be our board of directors, or who's allowed to appoint to the board of directors. Here's going to be the management of the company, or who's allowed to make decisions and changes to the management of the company. Here will be the reporting and whether we're going to have audited statements. And here's going to be, in this contract, it's going to say, how much money can be spent on capital expenditures. We need a new widget machine, and it's going to be $100,000. Well, management and the board can't make that decision. It's got to go right back down to the shareholders. It could say in your contract. But the most important part is it governs the buy and sell of shares that have already been issued from Treasury. So think about the company. The company's set up, and it has to issue Treasury shares to somebody. Treasury just means it takes shares out of the company, issues it to the partner. So you got partner A, partner B, right? Treasury shares, let's say you're going to have 1,000 Treasury shares. Well, 500 go to partner A, 500 go to partner B. Okay, those are Treasury shares. Now, what happens if partner B wants to sell his shares at a profit or at all to person C? And partner A doesn't like person C, and vice versa. Now partner A's got a new partner because he can't stop that trade, a secondary trade it's called. Okay, this has got nothing to do with the company. They've issued things at this point, but you want to stop your partner from getting rid of those shares to somebody. So you got a new partner. You didn't even want a new partner. And now now you got one, whether you want one or not. So a shareholders agreement stops that. It says you're not allowed to sell your shares at all for any reason ever, unless this agreement specifically says you're allowed to do it, and here's the conditions where you're allowed to do it. What are the conditions? Would be a first right of refusal. You want to sell your stock to person C, you first have to offer it to me at the same price, and then I have the right to buy it. Okay, it allows the partners to stop or facilitate a sale of the business entirely. Let's say partner B, your partner A and partner B wants to sell the whole company, wants to sell the entire company to a strategic purchaser, someone who's a competitor, and they're going to write a big check. Partner B wants to sell, partner A doesn't want to sell. What are you going to do? Well, partner B can't just sell half the shares. That doesn't do the strategic purchaser any good, right? So shareholder agreement would provide for that situation. And what it would say is, well, if you want to sell, first of all, partner A has a first right of refusal for the same price. And if they don't want to do that, then, for example, partner B might be able to sell his shares, and partner A is forced to sell his shares at the same price to that strategic purchaser. That is called a drag along. Okay, and then there's tag alongs, and this can get really complicated. All right, but the bottom line is there has to be a mechanism for getting rid of your partner, and for governing how secondary trades happen within a private company, right? Which is exactly what a shareholder agreement is for, and mostly is to protect the minority shareholder. I said 50-50, but What if your shareholders were 80-20 and the person with 80% of the share wants to sell all of the assets of the business, not the shares? But he says, yeah, that's cool. I'm just going to sell you the whole business as an asset sale. And partner B is going, whoa, wait a minute. I own 20% of this business. No. You own 20% of the shares. The company owns its assets. I control those assets, the company, because I have 80%. And I don't care what you say, right? So shareholders agreements govern that sort of thing. And they often have a shotgun provision for a rob situation, which is the other partner's not trying to get out, so you can't get that first right of refusal going, but you can trigger a shotgun to buy them out because you're dissatisfied. And the shotgun is, look, I want to buy you out. Here's my offer. It's for $100,000. And then that's, so partner A says that to partner B, and partner B has two choices within a time frame. That partner B either has to say, okay, I will sell my shares for the $100,000, or I will buy your shares for that $100,000, and it just forces this breakup at presumably a fair split up. Now, my advice to Rob on that, as he laments about not having a shotgun agreement, he didn't say that specifically, but that's what he means, I'm sure, is that shotgun agreements never work. And I'm not saying they're never going to work in litigation, but the person losing on the shotgun, I've never seen them just roll over and say, oh, well, I lost on that one. That doesn't happen. They go to the lawyer, they litigate, because here's the deal. If you don't have any money, the shotgun didn't help you, right? In Rob's situation where he doesn't have much money, maybe he can borrow some, but he doesn't have much money. He wants to get these shares back, and he's trying to get it back from the guy who was supposed to have the money in to begin with, and so supposedly that fellow has some money. Well, you're going to lose that shotgun if this guy wants the company, right? And if he doesn't want the company, well, you could have done this informally without triggering something. So shotguns kind of suck, but you need a shareholders agreement. Regardless, there's the type of things that deals with. Here's an idea. Don't give them the shares. Rather than worry about the shareholders agreement, you could say to the partner, okay, I'd like to bring you in 50-50, let's say, or whatever the number is. I'm doing it for these reasons. I'm going to give you options that are vested or shares that are vested based on performance, right? So that may not work great with an angel investor, but it works really, really well with the shares that you're giving away to your key employees. Remember my hypothetical example that you brought in the first non-founding partner and they were getting 20 to 25% of the business. Well, what you could say to them is, you'll get 20-25% of the business, but you're going to get it a year from now. You get the contract right now, but the shares won't be issued until you deliver X. Here's the milestones that you need to meet. That's a reasonable negotiation. And then if they don't meet the milestones, if they don't do what they're supposed to do, you haven't lost those shares and you don't have to fight or pay to get them back, right? Because that's a disaster. You have to pay somebody cash to buy back their shares when they didn't do what they were supposed to do to earn the shares to begin with. That's a crappy situation, as you can imagine. That's what lawyers are for. All right, here's another option for not getting yourself in this position. And again, when we're talking about bringing in key employees, this is not necessarily Rob's situation, but in my hypothetical example, very early on, and I mean immediately, maybe you do the founding partner thing, but when you start talking about the next employee and the employee after that, you need to stop talking about percentages, because from a negotiation perspective, 100% of the time, you will lose. You'll be more diluted. How do you stop talking about percentages, Scott? Easy enough. We have 1,000 shares outstanding. We will grant you to join this company and to perform these goals. We're going to grant you 100 shares. Okay. And then the person says to themselves, 100 shares. I don't know what that means. Is that what's the value of those shares? And then you help them with calculation. By the way, 100 shares are 10% in my example, but it could be 50 shares. It could be, you just got to stop talking about percentages. Instead, what you do is you say, let's do a million shares outstanding because that's easier than 1,000. Let's say, yeah, if you do this and that, and then we think the company 3 years from now is going to be worth $100 million. Okay. And therefore, our million shares, if we're not diluted anymore, are going to be worth $100 each. And I'm going to give you so many shares. You can turn that calculation into a future dollar value. Okay, you can turn it into a future dollar value, and that way you're quantifying the job. So you come in, you build this platform, you make, whatever the numbers work out to be, you're going to make $500,000. You're going to make, when we hit a home run, $10 million. You can quantify it for that person and put economics around the shares that you're issuing, and stop talking about percentages, because percentages mean nothing other than you're giving away, you only have the 100% to give away. You're giving away numbers, and it just becomes emotional. It just becomes, well, 10% is not enough. What the hell, you give me 10%? You got 33%. It's a stupid conversation. Turn it into dollars and cents. They're providing a service to you that is of economic value. Provide them lots of upside of economic value that is quantified. It doesn't mean you need to give away your company. So there's an idea. Always turn your share issuances into dollars and cents, and work on the value. Okay. Another idea relevant to Rob's situation is when you're dealing with angel investors. If someone's going to come in and they're going to say, here, I want to give you $300,000, whatever, and I want half your company. You do the work, I'll give you $300,000. I made up that number. I'll give you $300,000, and I will mentor you. I'll mentor you on this deal because you're a young entrepreneur and you don't know what you're doing. I'm an older guy with much money. I know what I'm doing. We'll go 50-50, okay? I'm giving you the money and the mentorship. You're doing the work. We're 50-50, fair deal. I suspect that was part of what Rob did, okay? Again, I don't know. I haven't talked to him, but I'm just using him as an example. So how do you fight that? Well, how you fight that is you look at a pref structure, or even better yet, venture debt, okay? So let's pick venture debt as an example. What does that mean? It means, okay, I'll take your $300,000, but I'm not going to issue shares for the $300,000. I'm not going to try and value my company at $600,000 and say your 300 is worth 50%, and my effort and thought is worth 50%. What you're going to say is, I'll take your $300,000 and I'm just going to put it on the balance sheet as debt and issue no shares for it at all, okay? But the first person to get money back out of this company is the debt, not the shares. So you get your $300,000 back before I get a cent, right? And now you can turn this conversation into a conversation about how much money should that debt be earning? What is an appropriate interest rate, which would be sort of a baseline, I owe this money no matter what, and participation rate. And you can do the participation rate through kickers of stock. Okay, what is a kicker of stock? Do the same thing I just said you were doing for the employee that you want to bring in, is you turn it into dollars and cents. Okay, I'll take your $300,000. With that, we're going to move the company from here to there, and when I do that, the company's going to be worth $10 million. If I gave you a 10% of the company kicker, right? If I turned it into like 100,000 shares out of a million or whatever, a 10% kicker on your debt, all of a sudden you got 10% of $10 million is a $1 million reward for lending me $300,000, something along those lines. Okay, so there's lots of creative ways to structure that. But there's a lot of better ways than giving away half your company for here's something fair, I'll give you some money, you put in the sweat equity, we're 50-50, okay? There's a way to turn the tables on that type of discussion. And by the way, it's a better deal for the investor because they have priority. They have priority over everybody else. And if things go wrong, if this thing is going to go bankrupt and it needs to be cleansed and put into a new company, the debt wins. The debt beats shares 100% of the time. 100% of the time. Equity people miss this entirely. Debt always wins. It's a better deal for the angel investor to do what I just said. It's a way better deal for the entrepreneur who's willing to bet on him or herself to not be diluted. You always want to not be diluted. Take the risk. Being an entrepreneur is taking the risk. Another idea for you, just want to throw out, now that we're talking about debt beating shares, if you are putting money into your own company, if you didn't take on a partner, or even if you took on a partner and you're subsidizing rent, you're subsidizing payroll, you go off and buy a printer, you're doing a bunch of stuff. In the Mary example, back on the shows we talked about Mary, she borrowed $80,000 from a friend and put it into the business, and that was the only money that business had to get launched, was the $80,000. What should she have done with that $80,000 in terms of papering it? Because she said, well, we invested it. It's invested in the business. Well, what the hell does that mean? You get two choices in a corporation. You can buy shares, or you can lend money, debt or equity. Those are your only two choices. There's different types of equity, there's different types of debt, but in the broad category, even if you just transferred the money in a bank account, well, that's a loan. It's an advance, right? And it's a documented loan with a paper trail, the terms of which are not documented or even thought about. It's still a loan. If you're not getting paid by your company, if you're investing in your company, if you're co-sharing expenses, you are loaning money to your own company. Document it, take security. You could take security. You could be the bank for your own company. And if you're the bank for your own company, debt always beats equity. And if debt beats equity and things go bad and your partner's freaking out and it dissolves into bitterness and resentment, act on your debt. You can take over the whole company. You can take over the whole thing. If you're the lender, you're in control, okay? Not necessarily Rob's situation, because I don't know what his debt situation is. Maybe it was a situation, I don't know. Always, if you can, if you're, and don't go out of your way to do this, to be tricky about it, but entrepreneurs so many times just, we needed to make payroll, and I just got some money off my mom and I put in 50 grand in the company, we made payroll. Okay, what was that? Oh, I don't know, maybe I need to issue some shares or something for that. No, you need a formal loan agreement. You probably need to talk to a lawyer, won't be expensive. Talk to someone who knows what they're doing, document a loan, register their security over the assets, be in charge. Okay, if you're lending money, you're a lender. Okay, you got to separate your hats. You can be an officer hat, which means I'm the management of this company, I'm the CEO, and I have rights and I have responsibilities that have nothing to do with the fact that I might also be a shareholder, have nothing to do with the fact that I might be a director, have nothing to do with the fact that I might be a lender. That's its own hat. Then you got a shareholder hat. Nothing to do. I'm dealing with somebody right now, and we're talking about this all the time. You own the company, you're the CEO. Those two things are not related, because if you have other stakeholders that want to change management, you still own your company, right? So you need to, when you grow up as an organization, these things are always commingled. If you start thinking day one about them as being separate hats, it changes your experience. It really does. And you're able to protect yourself in every situation. And you're able to have a conversation with a counterparty or a stakeholder. And when they're saying, well, you shouldn't have debt for this, it's not true. You're lending money, you get to be treated like a lender. Okay? That's just the way it is, because a corporation is not you. A corporation is its own thing. And if you're lending money to it, you need to do that. All right. Shareholder debts, debt beats equity. What else have I got? That's it. That's it on this topic. Since I have a little bit more time, I just wanted to pass on something I found interesting. This is a show about winning momentum and life and in business. This is a non-life thing, but non-business thing, more of a life thing. But I'm always been, I don't want to say fearful, but fascinated, concerned, interested in the idea of professionals and entrepreneurs working 20 hours a day, not sleeping enough. On the professional side, maybe not the entrepreneurs, but you're out drinking every night. Excuse me, choking on my martini again. And, as you get older, the health side catches up for you. And, I've certainly been there. I've always been relatively healthy. Thank you very much. Knock on wood. But, every year, almost every year for years, and it always happened the same time of year, right over the holidays, right over the Christmas holidays, into the new year, or right before that. And it's kind of when you start slowing down and your stress levels going down and you're rah-rah, like I don't want to say rah-rah, but you're even if you don't feel stressed, you're revved up and going, and then you come to this period of the year and you wind down. And I would get sick with the flu, and then 100% of the time my flu would turn into bronchitis. It would often turn into pneumonia. So I had recurring pneumonia like all through my 30s and 40s. And my doctor suggested that might not be a great way to roll. And so one day, a couple years ago, I'm going to give full credit to Gary Vaynerchuk, Gary V, of internet fame. And he said, now he changed his life from what I just described into now he's got a full-time personal trainer that kind of travels with him, rolls with him, a part of the group, and he's into great, makes some food and healthy stuff, and he works out all the time. So awesome, good for him. What I remember him saying, which I thought was really fascinating, is that he just decided not to be sick anymore. He just literally mentally decided, I've had enough of being sick all the time, and it just costs me too much at work. I'm not going to be sick anymore. And that he was suggesting there's a mental power in making that decision, which is something that I believe, and I don't want to believe it or suggest it to you look, I got friends right now who are really, really, really sick and in trouble. And I'm not trying to say that you could just think your way out of that, because that's absolutely not true. Shit happens in life and it's horrible. But when it comes to this sort of stuff, there's a power to thinking. So anyways, I decided I'm not going to be sick anymore. And then around the same time, I was listening to some other podcast on the benefits of vitamin D, and Dr. Gundry, I think, will hold me to that. And so I started pounding vitamin D. I picked up this natural path thing at the health food store the other day when I was refilling or going to get some more vitamin D. And on this pamphlet, it says, can vitamin D help fight COVID-19? So here's some interesting excerpts from it. And I don't think that any of this stuff is proper double-blind scientific medical studies. I mean, we're busting naturopaths. So take it for what it's worth. But they suggest that the vitamin D may cause, this study, actually done by researchers, suggests that vitamin D may reduce COVID-19 severity by suppressing the excessive inflammatory immune response known as cytokine storm that is responsible for so many COVID-19 deaths. The researchers hypothesize that vitamin D won't prevent you from getting COVID-19, but if you have adequate levels, it cuts the mortality rates in half. That was kind of interesting. Another one I picked up is that in 2017, a study of 117 long-term care residents who were 60 or older found that vitamin D prevents respiratory infections in the elderly. Compared to a monthly 100,000 IU dose of vitamin D, that's about 3,000 and change a day, I believe, to a much lower 12,000 IU dose. The seniors with the higher dose had a significant 40% fewer acute respiratory tract infections, 40% less. So at the same time that I decided I don't want to be sick anymore, I started pounding vitamin D, and I mean like 10,000 units a day, 5,000, 10,000. If I'm going on a bunch of flights, maybe a bit more. Now, listen, my doctor says don't do more than 5,000. I'm not a doctor. I'm not trying to give you advice on this. I've listened to podcasts where I think it was Gundry again, was taking 10,000 or 12,000 a day and 40 if he got it sick. There's no way to overdose on vitamin D. I don't know that that's true. And again, my last physical, my doctor said maybe I should back that down. There was no reason, like nothing came up in my physical that said back it down, but he said maybe you should back that down to 5,000. But here's what I want to tell you. A couple of years ago, I made that decision, and I've been pounding vitamin D, and I literally have not been sick since. I was going to say not sick a day. There's been many times where I've been fighting something for the day, right? I've been tired, you got sniffles, your throat's a little sore, whatever. I take my vitamin D. I've not missed a day of work, let's put it that way, because of being sick. And before, I'd be laid out 10, 12, 2 weeks, just laid out with a serious respiratory disease, in pneumonia or what have you, like every year. Not since has this happened. And to me, it's maybe it's completely psychosomatic, but to me, it has come down to the mental thought and to the vitamin D. I'm going on a plane, I take a bunch with me, or pound a bunch before I go on. I'm not advising you to do it. I'm advising you to research it, look it up. because if you want to be a success in life, if you want to be a success in business, you need to be healthy. You need to be healthy. And if you can't live like Rob and be an athlete all the time and eat well, if you're more like me, traveling around and not doing those sorts of things, maybe this is a good hack for you. Just thought I'd bring that up. I was reading this pamphlet and I thought it was interesting, made me think. Here I am talking about health and longevity while drinking a martini with you. Thank you so much for listening. Can't believe we got past 100 episodes. If you get a chance, jump on the Clubhouse show coming up Monday. And as always, please subscribe. We are on YouTube, Apple Podcasts, and Spotify. Talk to you next week.